So welcome everyone. I think in the interest of time, I will kick off here with a very brief introduction from my side. And first of all, a warm welcome to this interesting webinar on the Swedish EU Presidency and its focus on green transition and its implication for Swedish companies and investors. My name is Fredrik Nilsson, and I'm the current president of CFA Society Sweden. And we are glad to host this webinar tonight together with the CFA Institute. It's so nice to see more and more people joining the call. And we certainly have a very exciting and diverse agenda for tonight. We will start with an update on the Swedish presidency priorities from Justina Kemmerling, who is the head of regulatory outreach EMEA at the CFA Institute. After that, we will listen to Johanna Fager-Wettergren, who is the head of sustainable finance at Finansinspektionen, where she will focus on sustainable finance and the current challenges and opportunities on the EU strategy. Then we're moving on to the final point of the agenda. That's an interesting and interactive panel discussion with a number of experts, which will be moderated by Justina Kemmerling from the CFA Institute. So with that, I would like to hand over the word to Justina, who will take us through the first agenda point of the night. Thank you.
Thank you so much, Frederick, and a very warm welcome to all those joining. I know that in these times, people join, you know, as and when they have a moment. That is the online world. So I'm really happy to be here with you. Let me just give you some housekeeping rules. For the audience, please have your cameras and sound off. And questions, if you have questions for the panel discussion or for the keynote speaker, Johanna, please send them through the chat box, the Q&A rather. Also, the recording will be made available to attendees and on the CFA Society Sweden website, as well as the CFA Institute website. So look forward to that very much. So again, and let me apologize, because everybody in this panel and the keynote and the society, of course, is Swedish, and I am Dutch. And so I regret that I don't speak Swedish. So you will forgive me that this is done in English, but it's also done in English because we have viewers from across Europe. And so in order to give this more bandwidth also on the websites, we thought it was a good idea to do it in English. Let me give you some quick points on the Swedish presidential priorities. The open and competitive capital markets union is always, I think, one of the strong aims of the EU. But I would say that for Sweden, showing this, highlighting, because you have such a vibrant equity market, your pension system, but also investors are far more active perhaps than in other parts of the EU. So you can highlight to the rest of the EU what a vibrant capital markets union, and you have experience in the Nordic exchange on how to collaborate. And I think that is going to be very important when we look at where we're going with the EU. On green and energy transitions, what is very important is looking at some of the ambitious climate goals, boosting growth and competitiveness, and the challenges. So fit for 55 into action, and speed of that energy transition will be one of the priorities of the Swedish presidency. But also, again, jointly taking European steps towards independence from fossil fuels, not only necessary for the green transition, but also globally, and really looking to building that global economy. Again, major investments in innovative industries, looking at the right regulatory framework, and I hope some of the panelists will speak about that, and policy to attract investments is going to be important. And then if I look back to the Czech presidency, which was the previous presidency, again, they also highlighted the fact that the green and digital transitions must be implemented in such a way as to promote convergence. And that's the word we hear, convergence. Convergence is important, and adapting the skills of European companies and Europeans to changing circumstances, educating investors, educating companies, educating the financial players. All of this is incredibly important. And that is, we're reminded of that with the European Commission communication on financing the transition of the real economy towards sustainability back in 2021, which was to empower retail investors and SMEs to access sustainable finance opportunities. And also look to that financial reporting standards reflect the sustainability risks and building up natural capital accounting. Taking action to ensure that relevant ESG risks are systematically captured in credit ratings in a transparent manner, but also highlight the fact that fiduciary duties and stewardship rules of investors need to reflect the financial sector's contribution to the Green Deal targets. Again, making sure there's a transparency in the market, enabling supervisors to address greenwashing, building a robust monitoring framework to measure progress in the EU financial system, and cooperation between authorities to work to a common approach. All these were targets in 2021, and they will be a challenge for the Swedish presidency and for forthcoming presidencies. I will remind you very quickly of a report that CFA Institute produced back in 2021, looking at corporate governance and ESG disclosure in the EU, where we had some key attention points for policymakers. And we said policymakers could have a role in shaping optimal corporate governance in the EU and a stronger mechanism of board accountability. Greater dialogue between European and national regulators was going to be key, and clarifications on the EU regulations, because there seemed to be a mismatch on some of them. In terms of action points for companies, we said there should be better alignment of company and investor interest with those of employees in society. And there should be a more constructive dialogue with shareholders to establish longer-term relationships. Also a need for credibility of comply or explain, making sure that there is thoughtful justification for deviation. Again, for investors, engage more with companies, press them to comply with corporate governance rules, pushing to see the rights properly recognized, but also understand there is room for improvement in the governance of stakeholder and social issues without affecting a company's value. So the challenges are there. And first, before we go into a panel discussion where we take a look at the different sides, I want to introduce to you Johanna Fager-Wettergren, who's head of sustainable finance at Finansinspektionen. She has taken a very active role in the supervisory authority's work on sustainable finance and stewardship. And at the global level, she's a member of the steering committee of the Network for Greening the Financial System, and also active in the work apologies, I have a cough.
Many thank you, Justina. Thank you for this introduction, and hello everyone. And thank you for inviting me to speak at this webinar. So I will share with you what the EU strategy on sustainable finance means from our perspective as a supervisory authority. And I've also been asked to touch upon our own work on implementing the new regulations. So as you are all well aware, the EU has a very ambitious sustainability agenda, and also the EU has emphasized the important function of the financial sector to the transition to sustainable economy. And this function entails financial firms identifying, measuring, and pricing their opportunities and risks related to transition. So considering risks and opportunities in interest rates, asset prices, and insurance premiums simultaneously creates conditions for being able to actually channel the savings and investments to more sustainable operations. So this is the basic idea. And we as a supervisory authority also have an essential role in this ecosystem. And in 2015, the Swedish government decided on a new sustainability goal for the Swedish financial market policy. And that was, or is, that the financial system must contribute to sustainable development. And this goal has also been reflected since 2019 in our instruction as well. So we shall promote or work towards a stable financial system which contributes to sustainable development. And I have some slides I wanted to share with you just to illustrate a bit. And I will get some assistance here, thank you, with the picture or with the slide deck. So we can take the next one, please. Yes, thank you. So this is mirroring our sustainable finance strategy. So to reach this mission, we have identified some overarching goals that will provide guidance for the work on sustainable finance through year 2025. And these goals are, as you can see here, transparency, meaning good access to relevant, comparable, and reliable sustainability-related information. And then there is trust, meaning high levels of trust in sustainable finance. And finally, resilience, the resilience to sustainability-related risks in the financial systems. And the goals are closely linked to our mandates and are also really dependent on one another. And I will today highlight the first two of them, which also play a major role in reaching the third. So we can have next picture, please. So the first goal is access to relevant and comparable and reliable sustainability-related information. This is the transparency aspect. So sustainability-related information can be useful in many ways. We have access to comparable, reliable, and relevant information. This is an important condition for market participants to be able to consider and price risks and opportunities, and also for financial corporations to make well-informed decisions. They really need access to sustainability-related information from the entire value chain. Another group of users consists of civil society actors, such as the NGOs and social partners, which wish to better hold undertakings to account for their impacts on people and the environment. And other stakeholders might also make use of sustainability information disclosed in annual reports, in particular to foster comparability across and within market sectors. Corporate sustainability reporting is essential to get access to this information directly from the companies. And this is also why we as Finansinspektionen has prioritized global and EU work on this agenda or in this area. So both me and also our former Director General Erik Fedin has been deeply engaged globally in the work on setting up a global standard for sustainability reporting. Now, as we are progressing really fast in the EU, we have tilted our resources towards the development of the EU standard, ESRS, and mainly through the ESMA working group. And publicly, sustainability-related information can also be provided in other ways. For example, the coming EU Green Bond Standard aims to enhance transparency of green bonds. And this has also been an issue now during the presidency. And another such area of growing importance is that of the company's transition plans. And in this context, which is also really high on the global agenda, Finansinspektionen will continue to be active globally through global organizations addressing the use and role of transition plans from different angles and perspective. We will be active in NGFS, for example, and IOSCO. And the next level in this information chain is the disclosures from the financial companies to the end investors, which is where the SFDR clearly plays an essential role. And in this area, Finansinspektionen participates in the important work conducted by the Joint Committee of the European Supervisory Authorities, the ESG subgroup, which is led by Patrick Carlson, which is also here today and will participate in this following panel discussion. And this group work with the development of the SFDR regulatory technical standards and to provide guidance to market participants as they implement the SFDR requirements. And parallel to this work, we have an ongoing dialogue with the Swedish financial industry to better understand the challenges they face implementing this regulation. And this understanding is really key to us. And financial advisors can also play an important role in providing information to investors, which I will get back to shortly. And next slide, please. And then I want to address that access to information is key, but to maintain a high level of trust in sustainable finance, the information must not be misleading. So to achieve a high level of trust, there are some conditions that must be met. First, transparency on how companies are working with sustainability factors in their operations. Secondly, transparency on financial products that are said to be sustainable. The customers with sustainability-based preferences should be able to trust that products recommended by advisors are suitable based on the customer's preferences after verifying financial suitability. And finally, the regulatory framework for sustainable finance is suitable and consistent between sectors and products, and sustainability-related supervision is effective and convergent within the EU. So one of our priorities to reach these conditions is to prevent greenwashing, for which we have developed a strategy for our work. And in addition to ensuring that the information is accessible, a part of our strategy is to conduct supervision to ensure that product information is not misleading. In our supervision of sustainability-related disclosures of funds and insurance undertaking, we have done some findings, which we have published in 2 reports. So our review shows that there is room for development and improvement in the information provided to investors. For example, information can often be clearer and more specific. And also we expect managers to consider the conclusions from our analysis in their continued implementation of the regulatory framework. And we also encourage managers to adapt their operations to future guidance from the EU Commission and the EU supervisory authorities as these become available. And customers should also be able to trust that financial advisors always safeguard the customer's interests when providing financial advice. The greenwashing in this context can arise if advisors provide misleading information in order to recommend products that benefit themselves, or if the information is not relevant or is designed in such a way that the consumer cannot understand it. So we will prioritize following up so that such information asymmetry will not harm customers, but rather that financial market participants consider the customer's interests when providing financial advice. But also at the same time, we will be proactive and continue to maintain a dialogue with the participants in the industry and through encouragement of cooperation within the industry, and to facilitate guidance for the industry and to achieve a uniform supervision within the EU. We will participate in the work on this matter at the EU level. And we do understand that the industry faces challenges with the EU legislation, for example, because some of the interconnected legislation starts to apply at different points in time. So our focus at the moment is to support and to monitor the implementation of the rules by the companies. As more legislation starts to apply, we will also supervise more actively. On EU level, in addition to participate in the work of Patrick's group, as mentioned before, we're also participating in the current work on greenwashing conducted by the European supervisory authorities, all three of them, the ESMA, the EBA, and EIOPA. And the Commission has asked us for input on, for example, a definition of greenwashing in the financial sector, what behaviors that can constitute greenwashing in markets, and if supervisors have the appropriate tools to prevent greenwashing. And in the context of trust in sustainable finance, we would also like to emphasize the responsibility of the board and management in the work with the sustainability, and more specifically, and this is not unique for sustainability, but that the board ensure that there is a clear waterfall from the board's overarching goals in the area of sustainability and a clear division of areas of responsibility with clear processes and procedure descriptions, and that issues are handled in relevant decision forums and also controlled by the internal control functions. So from our perspective, it is important for us to see how processes and procedures are adapted, and that policies, established goals, and communicated ambitions are actually complied with. And then, can I ask for the last slide, please? Thank you. As you understand, sustainability has become an integral part of our work and is high on our agenda. And we also have these high expectations on companies in the financial system. So everyone needs to do their part if we are going to create a stable financial system that contributes to sustainable development and reach the goals set up by the EU and Paris Agreement. So thank you very much for your attention.
Joanna, thank you so much. Apologies for this coughing that I had, but that's the remnants of my flu. It was lovely to see how you highlighted actually some of the action points that we did raise in this research of ours back in 2021. But now let's go to the panel. And let me introduce my panelists. If I could ask them to start sharing their video, perhaps that will be lovely if you could come on. So first of all, we have Ulf Erlandsson, founder and CEO of Anthropocene Fixed Income Institute. Hello, Ulf. He was one of the pioneers in the green bond market, as well as in high frequency credit trading derivatives, and is really an expert in this topic. So I look forward to that. Next, we have Svante Forsberg, who's chairman of Styrelseakademien, so the Swedish Academy of Board Directors. My mispronunciation is terrible. After a long career at Deloitte, Sweden, as a managing partner, you work in different boards and especially as an advisor. And you have, as amongst your other assignments, you are chairman of the Swedish Academy of Board Directors, which is the second largest institute in Europe with 8,000 members. I didn't know that. It's interesting. Next, we have Patrick Carlson, who is a senior policy officer at the European Securities and Markets Authority, ESMA. Welcome, Patrick. Lovely to have you with us. He is a senior policy officer in the investment management team at ESMA, which he joined in 2019, and he contributes to investment fund policy development, focusing on sustainable finance and disclosure, Mr. SFDR, I think. Jonas Tullen, head of asset management at Erik Penser Bank. Before joining Erik Penser Bank, you were head of asset allocation at Nordea Bank Wealth Management, and you were also head of strategy and research. So very welcome to you, Jonas. And last but not least, Anna Wifhus, ESG manager at SSAB, a steel company with a leading position within the development of fossil-free steel. So look forward very much to hearing all your different perspectives, and a warm welcome to you, Anna. So my panel, you have a great challenge because I have a lot of questions for you, and we have 60 minutes. So I'm going to, if you see me wave a hand, please respect it and sort of tail off your remarks. We have about five minutes per question, more or less. So we can play with that. I'm going to start off with Patrick, and Patrick has already said to me that I need to cut him off if he gets too keen. So don't, Patrick, I will do so. Patrick, what role has ESMA been playing in the identification and prevention of greenwashing risks and the implementation of the sustainable finance legislation? This is a very big question. I'm sure you could speak for an hour, but you're going to have to reduce it. Patrick.
I'll try to be brief. Thank you very much, Josina. Thank you for CFA Society for the invitation to ESMA. I'm pleased to represent it on this panel today. There are three major developments that I wanted to highlight with regard to basically what we're doing right now. It feels a bit unfair. It's not strictly connected to the Swedish presidency. It's simply the fact that it happens to coincide with this 6-month period, at least. So there are indeed a lot of things happening right now on the supervisory level that I wanted to highlight. Firstly, on SFDR itself, we are obviously continuing the work on clarifying certain concepts. We have asked the Commission some questions. We should expect responses to those soon. We've published Q&As ourselves on the practical application of some of these measures. But the really big news, obviously, is a very significant consultation that we're about to publish, looking at a number of the areas covered by the delegated regulation. So that's the level 2 of SFDR. We received, so I say we, I mean the 3 ESAs, again, not just ESMA. Of course, Johanna is right, Johanna and Finansinspektionen are part of the working group on this particular project, but we received a mandate from the European Commission last April to enhance the level 2 disclosures, particularly in 2 areas on the principal adverse impact indicators used for some of the disclosures, and also on the decarbonization target disclosures. We are just about ready to publish this. I had originally wished that we would have been ready already for this event, but unfortunately we will not. Instead, we expect to be able to publish that in a couple of weeks' time, just before Easter in early April. And that consultation will cover not just those 2 parts, but also some other parts that we thought could be usefully considered as a part of this review. We're obviously extremely keen to hear from CFA Society members and other stakeholders, of course, on this. I think it's a good opportunity to consider the value and the usefulness of some of the disclosures that we created in the original RTS. I know they've only been in application since the 1st of January, and indeed some changes have already been made with the nuclear and gas disclosures. I won't go into that in any great detail, but you should perhaps consider this consultation as a broader review possibility to look at the level 2 and some of the aspects and how they work. We received a lot of feedback, obviously. Some of them ended up in Q&As, others we saved for this consultation on the basis that it's interesting to talk about that. Now, quickly, Josina, two more things. So greenwashing, fortunately, Johanna mentioned this, so I don't need to go into too much detail on this, but indeed we are conducting a call for evidence here and a call for input indeed from the Commission on this. We have an interim report coming in May, where you will see some of the interim findings that we've done on the basis of the very good consultation that we ran in the 3 ESAs over Christmas and into January. I think we learned quite a lot from that, and we will be publishing an interim report on that. I think the real highlight will be, of course, the final report due in a year's time in May 2024. Finally, we as ESMA raised some investor protection concerns with the use of ESG and sustainability related terms in fund names. We ran a consultation from November to February, and we obviously have now closed that at the end of February, and we are analyzing the responses and considering the next steps. I think as a brief highlight only, Josina, I can say that while there is broad consensus that there is a greenwashing concern here with regard to the use of particularly Article 8 SFDR disclosures as a proxy label, I think there is a broad disagreement about the kind of measures to be taken to address that investor protection concern. So we certainly have our work cut out in ESMA, and we hope to be able to communicate the next steps on that in Q3 later this year.
Wonderful. Well, Patrick, you managed to really be extremely concise and give us all that wealth of information. And certainly I put out a call to those listeners and viewers, and also our CFA members throughout the EU, that don't forget to wade in through the consultations to ESMA. I'm going to turn to Jonas Tullen now. What are the current and future challenges of the EU legislation on sustainable finance for asset managers? Jonas.
Yes, well, I think there are the number of them. So where to begin? I think the importance of data has increased in making that transparent, both for investors but also for regulators. I think there's a coming educational enormous hurdle in order to explain what is an Article 9, what do we have to do to make an Article 9 fund, and what is the difference from an Article 8? What can you expect in terms of revenues or actually returns on your capital? But also, how do you make it visible or short and sweet enough for people to actually understand what are we doing in order to fulfill an Article 9? That said, I think there's another issue in terms of, as I mentioned before, the importance of data. We want objective, we preferably want third-party data. There aren't that many suppliers out there, and there's an enormous tendency for people to sort of being drawn into, I wouldn't even say a handful, probably talking about 2 or 3 data providers in order to illustrate the entire on Article 8. The other thing is that there's a bit of a challenge is that there's so much data. For our Article 9, we go through 160 billion data points. For us, it's not that big of a deal because we like data and math. But for for example, a regulator or a fund company or our own compliance, do we ourselves understand what we mean in turn? How do we calculate implied temperature rise, et cetera? And this field is only growing and growing. So I think there's a lot of issues here, both from data and can we trust the data, then with the usual caveats on that, to how can we actually make this understandable? Because the other risk is that we always simplify things. I think it's the state today. If you look at different platforms, for example, that actually doesn't say anything on what the fund is doing. Then we're also giving a few data providers an awful lot of power in terms of both charging, and that will cost the retail, and their definitions becomes almost mandatory, and all the way back to what are actually people doing with all this data, and can we control the data? So I think there's a number of challenges from an asset allocation point of view, and not even talking about the actual investments in companies. That's in sort of next page, and how do we actively engage when we speak to them? As a sort of, I can finish with one observation I've done lately is that there are a lot of companies out there doing their own green policy. They have their own way of reporting. But for us as an asset management, you could almost, and I'm exaggerating a bit now just to make a provocative argument, you could almost stop doing that. Because I, as an asset manager, I have my regulation that I have to fulfill in order to claim that the investment in this company is sustainable or not, regardless of what the company says. So the company's dialogue with rating institutes is more important than the dialogue with me, because for us, it's data. So I'm going to drop, I can stop there. There's a number of challenges, but all it must be said, I think there's a lot of positive trends in these challenges for the last couple of months, and even last year and a half.
Thank you very much, Jonas. And I hope later on in the conversation, Anna and Svante will pick up some of the points that were raised by Jonas. I'm going to turn to Ulf first of all now, briefly, because I've got a couple of you that I want to test on this question, which is, what are the main challenges related to the principles of adverse impact disclosures under SFDR? And what kind of analysis is expected from fund managers? So Ulf, and then I'm going to turn to Jonas again very briefly, and Patrick in turn. So take a small amount of time. Thanks.
Yeah, following up on what Jonas said here, I think data is really important, but that also provides an arbitrage in the sense that if you're able to circumvent the data through various structures or various strategies, then you actually do need to do a lot of forensic analysis around that, and we're seeing that. I'm coming from the fixed income side, and we look at a lot of sort of the private asset side and how they use public fixed income markets. It's a much more opaque marketplace than what you see in terms of public equities, and we see quite a lot. And Larry Fink said something back at COP26 around the arbitrage of a lifetime. The more cost you have associated with actually going through and looking at the companies, the more profitable it becomes to actually get this in structures where you don't have to disclose the same way. And if you go into the principles of adverse impact, that becomes very obvious that if you can sort of layer your way, get structures that you get one distance away from some of the adverse impacts, and you don't have to report them, then that might be a better thing to do from an economic standpoint than buying the exposure and then trying to explain why it's there. So that forensic analysis, and that's hard and it's very resource intensive, and I think that can be problematic.
Thanks, Ulf. Jonas, do you want to have a very quick comment on that?
No, I think it makes perfect sense from our point of view.
Okay, great. Patrick, any comments from your perspective?
Yeah, I mean, circumvention is always a risk. Although, of course, you have to wonder, why are we even doing this at all? Maybe there is no climate change. Maybe everything is fine and we don't need to worry about rules at all. I don't know. Sometimes I feel frustrated that it seems maybe only the regulators care about this. And in fact, there is no problem out there that we're seeking to fix. Now, maybe we can disagree about the way we're trying to fix it or address at least the information availability. Fine, okay. But okay, the PAI circumvention shouldn't be that easy, at least. We have provided at least some expectations that there's look through. So if, for example, an investment is channeled in a way that the entity in which invested doesn't actually undertake the economic activity that causes the adverse impact, then that should be looked through to where the ultimate money goes and where that activity is actually undertaken. Of course, that maybe is easier said than done, but I mean, the obvious purpose of the disclosure of the principal adverse impact of investment decisions on sustainability factors is to find out the bad things that the investments finance. And so we try to be as comprehensive as possible. We've created 3 categories of entities that cause these impacts. And we've created indicators for each of these types of entities. So that's investing companies, sovereigns, and real estate. It's a pretty blunt system, but at least it's a start, and we'd like to see the evidence. I am very excited to see the first statements under the RTSs, which will not be due until the 30th of June. So we haven't actually seen any yet, but hopefully when they become available, we'll better understand some of the strengths and the shortcomings of the system we have created. And I think you will find that in the consultation we're running, we're asking a number of questions about the way in which the information is gathered and the way in which the calculations are made. That hopefully will make it easier for the preparers and clearer also for investing companies about the information they have to provide. Here, the obvious answer is the ESRS. Under the CSRD, the system of reporting for companies that's being created by the CSRD. I know we're coming on to that, but it is, of course, the essential component of information for financial market participants investing in companies reporting under that regime, because the PAI indicator information will be available at least through that.
Thanks, Patrick. And yes, this is a work in progress, and we all realize this. So I think the more interaction between industry and regulator, the better, actually. Patrick, I'm just going to very quickly ask you for, very, very briefly, you mentioned the recent consultation of funds names. Can you highlight some of the guidelines that you proposed for the funds and how the introduction of quantitative thresholds can improve investors' understanding as regarding funds' investment objectives and characteristics? But briefly, please. Thanks.
Sure. No, I mean, so the consultation essentially reflected growing concern about greenwashing with regard to the SFDR disclosures. Essentially, SFDR is a transparency regime. Nonetheless, the disclosures under Article 8 and Article 9 are being used as quality labels, essentially sustainability labels. I'm not blaming the industry for doing that. There literally is nothing else at European level. So I think in a way we have to look at level 1 here and see how that can be better fixed. Obviously, the European Commission is in charge of that, and I know that they are conducting a comprehensive assessment of SFDR, so that will play an important role. Nonetheless, I think that's going to take a long time. In the interim, we are concerned, so we issued a consultation, proposed some guidelines on requirements when ESG or sustainability-related terms are used in fund names. This is restricted to investment funds only. So we propose thresholds of 80% of investments used to meet the environmental or social characteristics if it's an Article 8 fund, or the sustainable investment objective if it's an Article 9 fund. And then a second threshold of 50% if the fund makes sustainable investments. And more importantly, uses the word sustainable or any word derived from the word sustainable in its name, then the 50% would apply. On the other side of the equation, we are also proposing certain minimum safeguards in the form of exclusions, where we have proposed to copy the Paris-aligned benchmark exclusions from Regulation 2020-18-18. Article 12 has a number of exclusions for Paris-aligned benchmarks related to controversial weapons, tobacco, social violations, violations of taxonomy, DNSH, and fossil fuels. So we consulted on these. We received a very colorful feedback, very good feedback, very constructive, I have to say. Not only criticisms, but genuinely constructive feedback. So we are, as usual, awed by the knowledge and expertise and positive attitude of the European financial industry, but also NGOs and industry and investor representatives. So we will be digesting that. I can't really give you much of an insight now into the next steps. We need to think about this further. I think the feedback has given us a lot of food for thought. We published the responses, so anyone can go on the ESMA website and read those. There's over 120, so it's quite a lot, but there are some interesting highlights there.
Thanks a lot, Patrick. And yes, there was a lot of interest. Ulf, you know, you're active in the bond markets. What are the examples of bond funds using ESG or sustainability related terms in their names? Could you give us some examples on that?
Well, it's it's quite common, and the fact that there are, for example, a number of vehicles using ESG in terms of their UCITS funds, and having a fairly low sort of just exclusion of the absolutely worst ESG performance in terms of the name selection. So there are some issues there. I'd say also there are some issues more almost down to the security level. We have been writing some analysis as of late of a funding vehicle set up in Luxembourg by a private interest to provide funding for part of Saudi Aramco's balance sheet. Now, Aramco is a company that would normally be excluded from ESG indices, or it is, whereas this particular vehicle named Green Saif, which green is green and Saif is sword, scimitar in Arabic, is then the bonds issued out of that SPV is actually being classified as within the scope of certain ESG funds. That's one of those sort of private to public or public to private type of transactions which we find is quite hard, and creates these sort of forensic type of demands on doing some of the things. And they're not small. I mean, in terms of that transaction and another transaction similar to it, which relate to pipeline networks in Saudi Arabia, and these are global interest investing in this, but actually using EU legislation in terms of setting up the SPVs. These are amount to around $30 billion, and that's happening right now. And I think things like that needs to come up, and I do think there's a growing view and from the legislative side to looking at this.
Thanks a lot, Ulf, for those comments on the bond funds. I'm going to turn to the companies now and looking at some of the challenges they face. Anna and Svante, on to you. On what are the challenges for companies in the preparation of required information to disclose on taxonomy? Very wide question, and we have 5 minutes for this question. So please, I can give you a little bit more time, of course. Let's start with Anna and then go to Svante. So Anna, please.
Thank you, Josina, and thank you for inviting me to the panel. Well, let me start with the big challenges. As Patrick said, what are we talking about here? Steel industry accounts for 7% of carbon emission globally. So SSAB is kind of part of the problem, but we also have a transition plan to almost eliminate all carbon emissions until around 2030. So that is the big issue for us working on. And then taxonomy, well, being such a huge emitter, it was quite clear to us that we wouldn't beat the climate criteria for the Nordic operations, even if we have almost the most CO2 efficient operations in Luleå in Sweden. But our scrap-based steel production in the US is the raw material is almost 100% recycled, so there we meet the criteria. So that was quite an easy exercise to account for. But the complicated things, I think, for us and for many other companies is to do no significant harm criteria. And in this case, we needed to kind of do the analysis of the EU regulation that the taxonomy and the NSH criteria based on the US operation. And this is a new thing for us and many other companies as well, because the aim and the focus of the US environmental work we do is to comply and refer to the legislation there. So we needed some external help on this. And we did the assessment, as for the best of our knowledge, basically, based on what we think also the purpose is of the taxonomy. So you will see in our annual report, it's released tomorrow, that we account for that our scrap-based production in our assessment is aligned with the taxonomy. But this is, we try to be as transparent as possible with these, assumptions or kind of disclosures, because we don't know if this is the way to do it, but no one really could tell us how to do it. So I'm quite curious how the investor community will react on this. I must admit, until now, we've been asked very limited questions around the taxonomy. So let's see how it develops in the next years.
Well, I think I wish we'd had this conversation after the publication of your annual report, and we might have heard some reactions already. But anyway, Svante, over to you.
Thank you, and thank you for having me here and for your kind introduction, Josina. I think, getting to Patrick, I think it's very important that Europe will be both climate smart but also competitive. And maybe I can ask you, Roberto, to put on a slide just to have the discussion about that balance. Because I think, from my perspective, I think an hour is not enough to discuss the medicine that we are discussing. I think this is an article in the Financial Times from Monday listing the hurdles for investment in Europe. We are of course competing with US and Asia in getting investments here in Europe, and you can see that here that regulatory environment is second, number two in among the hurdles. And I think one issue here is and I very when I heard your discussion here, it's clear to me that all the medicine that is in this area is bottom-up oriented, not top-down. I think we should have discussion about if we should have principle-based regulatory or we should have bottom-up and a cookbook. And what Anna said, very difficult for SSAB to understand if they do right. So I think the taxonomy for me is a black box, having lived my whole life in the financial reporting world where you have reliable data, you have systems which have been working for many years. And here we have very few of those systems that are reliable. And also what Joanna said from the FSA, that reliable data is very important. And we don't have reliable data. That's my conclusion. So I think, but I think that companies are very ambitious, as Anna said in SSAB, and also many other companies around Europe are very ambitious and want to do the right things. but the system that we are now discussing is, in my opinion, too complex and too unreliable, and it's not reliable. So that's for where I come from. Sorry to be critical.
No, and criticism is what stimulates debate. So I think we all, as long as it's respectful, we can all agree to disagree, and I think that's what helps build constructive dialogue. I think I would like to go, bearing in mind you mentioned reporting, looking a little bit at the Corporate Sustainability Reporting Directive, which is incorporating the concept of double materiality. How should companies disclose non-financial information under this approach to allow investors to make investment decisions while understanding the impact of the company's activities on the environment and society? And how can investors themselves understand the double materiality concept? So here I have quite a few of you I want to go to. Perhaps let me start with Ulf and then go on to Patrick afterwards.
Well, I want to join in what Svante says here, that there are a lot of question marks out there, and there are lots of costs associated with trying to follow the guidelines and not knowing whether you're doing right or not. And there is a dimension when you look at the industry, right, that where the big behemoths, especially after past weekend, I think the top 3 or 4 asset managers in the world are non-EU based, and they might have certain advantages in terms of size of being able to purchase data and do a lot of this analysis. So this drive to size, I think, should be a worry for not at least the Swedish industry participants. When it comes to double materiality, that's another question there, where there are some simple questions you can ask in double materiality. And as I work in a slightly less known asset class, just if you think about how do you calculate materiality or double materiality across different investors in a company. So how do you switch between the equity investors versus the debt investors and the various parts of the debt capital structure? And even a simple question like that is actually, there's very little theoretical founding or guidance on how you're supposed to be doing that. And for many funds, or especially asset owners, you will be owning both equity and debt in the same company, and we don't even have a recipe for exactly how we are going to allocate across that. So a lot of question marks. It's very hard to measure some of the positive impacts, and there is a risk here as well that people who do it in a way that's not maybe intellectually honest are actually at front of the debate, because they at least get to some results. Sometimes there's just not a good result, and we should respect that.
Yeah, thanks Ulf for that call to reality as well. I'm going to turn to Anna. Yes, Anna, next to you, please.
Thank you, Jasina. No, I just wanted to add on what Ulf said, which I thought was very good phrased. Like, for example, we, as a first note, double materiality is not new to us. So it's about risk for people and planet, and also financial impact from sustainability factors. But let's take climate change as an example again. We try to do it by the book, to do a scenario analysis on the financial impact on our business. And we learned, I mean, I'm not a climate expert or a climate researcher, but I learned from the experts that it's really, I mean, it's very complex models, very, very complex quantitative ideas how climate change and how you can conceptualize that in 2 scenarios. And then to calculate the financial impact for something that, I mean, we feel the climate change already today, but in a broader scale, perhaps we need to wait in 50 years until it materialized in real impact. And to put a number on that, I mean, we could do it, but then again, we're not even disclosing our forecast on the EBIT for the next year to the financial markets. So it's like a mismatch of information to give to the market. And I'm a bit worried interested in how investors should use this information in the beginning, and how we should be compared to peers, because just like Ulf said, that depends on what method you use, what standards, and how you calculate it and how you report it. Doesn't really mean if we would report something else than our peer, that wouldn't necessarily mean that there's a difference in risk or financial impact in the end. So that's something that we are watching quite closely.
Thank you, Anna, for highlighting that. And I think, of course, there's a challenge because somewhere along the line on sustainability, perhaps you're giving more information than you might indeed on, forecasting EBIT, etc. So big challenges. Svante, over to you, and then I'll go to Patrick. Svante, you're mute.
Sorry. Are we on the CRD or on the boards?
We are on corporate sustainability reporting.
Okay. No, it's obvious that what Anna says is very complex, and I think when we have the steering, I can say, give an example, steering documents, the US independence declaration is 300 words. With also the 10 guts bud, I don't know the name in English. And when we have the legislation for egg, duck in the EU, we are 27,000 pages, 90 times more. And the documents here are so extremely complex. So when the consultation period was 100 days for a document of, I think, 1,000 pages, very difficult documents, legal document, then I think we are going too fast, and it's starting a lot of discussions, and we don't understand the complexity. And then it's very easy to have greenwashing as a concept on that, consequence on that. So I think we have to really think about how can we simplify and put the efforts or concentrate on the larger issues, not the bottom-up issues. That's my point on the CSRD.
Thank you, Svante. Patrick, I don't know if you're able to come in on this at all.
Yeah, so the beauty of being Mr. SFDR is that I don't have to be Mr. CSRD or, say too much about double materiality, except that it's very important to us. We have several Mr. and Mrs. CSRDs in ESMA who obviously tell me that this is very important. So that's the message I convey. I take the point on complexity. It's not easy. And I'm not sure to what extent it's true. I'm sure financial related sustainability disclosures is hard enough already for financial companies. I'm sure sustainability disclosures for non-financial companies is equally hard, potentially harder, obviously, depending on the size and the resources available to them. I don't think we're underestimating the challenges involved in both complexity and resources necessary to comply. I think we have to bear in mind why this is important, the kind of outcomes that we want to achieve with this, to justify why we urge haste and compliance and rigor in terms of those disclosures. It is genuinely important. It's not just a regulatory exercise to satisfy someone sitting in an ivory tower in Paris. That's certainly not the case. I hope that's clear to absolutely everyone.
Thank you, Patrick. And I know that's difficult because, as you said, you're not Mr. CSRD, and I asked you to come in on that. But so thank you very much. I'm going to turn to the role of company boards because, of course, they have a role to play. They have a challenging role. Are they up to it? What can be done to help them? What do shareholders expect? So in the light of the increasing shareholder interest on sustainability, what is this new role for company boards? And should there be a training on sustainability envisaged across? Should there be more communication between the asset management and the board directors? How does the flow from the board go to the senior management, to middle management, and between the board and the auditors, let's say? So again, challenges there. Let's start with Anna again, if you would like to kick off.
Yes, and this would now be my private opinion, not necessarily SSAB board's opinion, but I believe the sustainability reporting issues is a topic for the audit committee, so I don't see a need for a separate sustainability committee on that. But I do see that sustainability reporting is becoming quite a discipline on its own. And I think the competence for handling that is in the audit committee being used to handling the financial reporting, the internal control system, etc. So it's a natural place for it. So if you ask about training on sustainability, I think that's always good. But training on sustainability reporting is probably also getting more common and needed going forward.
Thank you. I think that's very clear. Svante, what do you think?
Yeah, I totally agree with Anna. I think I think we have to develop and try to come up with KPIs so we can have not 100 KPIs, but maybe 3 or 4 KPIs for the company or for the industry. And in that respect, I think that the board has to be much more drilled in this issue, of course. But I don't think we should take in experts in the board in this area, because I think the board has many different angles to think about and to balance, so to say. So I think definitely we'll have more time for education, but also I think to sort of develop the KPIs or KRIs that we need in this area. But once again, try to be focused on the larger issues, not the bottom-up issues.
Thanks a lot, Svante. Jonas, from the other side, let's say the asset manager, what is your perspective on this?
Welcome to the complexity of everything. It's quite interesting that we as the asset manager have had to report on these companies for quite some time, and I recognize all the difficulties. And I think the challenge here could be that there are solutions on all these matters from an asset management point of view, or there are regulations that sort of provide answers. And the trick here could be potentially to what extent the corporate side wants to adopt the same viewpoint, which I guess it would be quite simplistic from a regulatory point of view. But the complexity thing, and I think this is I don't know if this is right or wrong. I mean, it is what it is in that sense, that asset managers have to go before corporates in that sense. If you can sort of make that draw that broader picture, and all these issues and obstacles, and that's why I think that's why I made the comment before, that we as an investor that are managing an Article 9 fund, we don't even read what the corporates themselves thinks is sustainable or not, because we already know what we have to do with the data that the corporates provide themselves, or we get someone to provide for us on the corporate. And I think that's the good about it. It is what it is, and I think that could potentially be quite an interesting challenge when corporates became more and more attuned to, okay, this is actually how the financial markets from an investment point of view is looking at us. Do we agree with that, or do we think it's horribly wrong or anything like that? That said, even if we have companies that disagree with us, and I've had these discussions with big Swedish corporates, and they're perfectly right in their opinion, but I can't do anything because I have my regulatory environment that I need to adopt to. And it is almost like, I mean, one part has to go before the other part, and this time it was decided that we as asset investors have to go before the corporates. I don't have any thoughts if that's right or wrong, but it creates quite interesting reverberations that are going to go through corporates, especially when you come into, I guess, more debatable issues. Like, for example, if you break a controversy, it's quite common now from an investor point of view that, yes, you have to amend it, you have to prove your case that you're not breaking it anymore, but there's a decay to your breaking that controversy. That decay factor is crucial, because if you end up with a red flag for 2 years, 3 years, 5 years, you're out of a number of funds and indices. That decay factor is obviously subjective to whoever puts the decay factor. And this go beyond what I think is more simplistic, like, I mean, CO2s or I mean, actual breaks or SRIs or anything like that. And I think that's the kind of vague points that we have had some discussions with corporates, is, saying that, we have amended our case, we're doing everything right by the book right now, but it's like, unfortunately, you have a decay factor. It's going to take 5 years, and you're out. That kind of harsh reality, I think, is not really understood amongst corporates. So there's a lot of discussions or informations rather than debates, I would say, but there's probably has to take place between institutional investors and fund managers like myself and corporates. And not that one side is right or the other one is wrong. It's just a level of understanding that has to be met, that we can't do anything with a great piece of information. Looks, this is the most sustainable company in the world if it doesn't fulfill our regulatory environment. So I think that's so I think it's great the corporates have to tackle these issues. I mean, we've done it and we already have solutions, right or wrong. It is a little bit what it is.
Thank you. And I think, you reminded us that it's a building of communication. I remember when we did a study back in 2016 on SRD, revision to SRD, together with London Business Schools, and we talked with some asset managers, and we saw that the perspective already was changing from just being aware of certain things to actually having far more awareness of the whole stakeholder community, the engagement process, being more dynamically engaged. And I think probably that SRD revision kickstarted that and led to more. So I'm going to ask all of the speakers now, because I'd love them to give examples from the different perspectives of greenwashing practices occurring. So I will be really interested to see, from your different perspectives, what you have seen and where, or if you haven't seen anything, if you see, where is the potential perhaps of greenwashing? So let me start with Ulf, because you just switched back on. So I'm going to turn to you first.
So it's one of the most common questions when you get journalists calling you, and they want you to call out some sort of greenwashing and point fingers and so on. I do think, and I think the most serious form of greenwashing is actually one which is slightly outside the public sphere. Coming back to this again, but there are lots of entities in the European financial markets that are actually engaging in funding of activities that aren't particularly good, but they are not reporting in the same way as the traditional or the public financial industry actors are doing. Make an example, was a huge bailout of Russian-related coal and gas company last year. And that was funded by one of the sovereign or sub-government organizations in Europe. There are a massive green bond issuer at the same time. And the problem there is that there is no big debate, even if you go into their webpage, so you can barely find that they just spent 25 or 30 billion euros in terms of helping out this company, which has a very poor footprint. And it's part of a transition story, and I understand energy security and all of that, but I do think the point around transparency is really important. And in this case, it's also one where most of the investors in the bonds of this issuer are themselves non-regulated entities. So, pension for government pension funds. I know the Swedish pension funds will have massive exposures to this type of issue. And there we have very much less debate than when it comes to Jonas buying particularly, companies in public equity markets, and they are really hard and making all the hard calls and questions on. So I think that's a sort of greenwashing that's going on there, where we're not looking at some of the major issues which are slightly away from what we can see in the stock markets.
Thanks a lot, Ulf. Svante.
Yes, I think back to the complexity, it's much easier to have greenwashing when it's in a complex system. There can be misunderstanding and misinterpretation, but it's also easy to make fraud when it's complex. One very recent example is Silicon Valley Bank, where you can see the G in ESG. They had had very good ESG report. They were highly ranked, one of the most sustainable banks in US. But anyway, everything happened during a weekend, and the bank ran, and the bank was collapsed. So I think it makes an example of how complex these issues are, and I think we should have respect for them, and also, but again, have the community or the Silicon Valley Bank disclose the largest risk in a proper way. Then it had to be much easier for the shareholders and so on to understand the high risk that environment that they were in. So but they maybe wrote it, but nobody could see it.
Anna, your perspective?
Yes, I think the steel industry might be where the financial industry were before SFDR. There's no standard on green steel. So as you might have seen in the background, we call it fossil-free steel. So as waiting for a standard which we really support, we just need to try to be as transparent as possible on what we mean with the transition and our goals and targets, etc. So, but I'm not hoping for SFDR for the steel industry. That's not what I'm saying, but I can see the parallels.
Oh, great. Patrick, do you want to comment?
Yeah, sure. I mean, very tangible example we found in the research we did for the fund naming proposal. We found that there were about 4,000 out of 30,000 UCITS funds in Europe that had these terms in their name. Slightly worryingly, 400 of those 4,000 were disclosing under Article 6. Now, as some might know, one of the ways in which a fund can promote environmental or social characteristics is to have these terms in their name. That means that those 400 funds are misdisclosing. They should be disclosing under Article 8, not under Article 6. SFDR is not a voluntary regime. It's not that you can pick and choose, you know, which article you want to disclose under. Either the financial product promotes environmental social characteristics and then it's Article 8, or it has sustainable investment as its objective and then it's Article 9. Now, obviously, if you design a product to disclose under them, then that's obviously fine, and that's the choice and that's correct. But where those terms are used in the name and therefore giving investors an impression of sustainability and then not disclosing any environmental or social characteristics, that's obviously in breach of SFDR. So that's quite a concerning finding we found in looking at the current use of terms in Europe when we launched the consultation.
Thanks a lot, Patrick. Jonas, I'm going to turn to you. There's actually a question which I'm going to ask you, which is, because of all the greenwashing accusations, there are also accusations of green hushing or green bleaching by companies who don't dare to stick out in fear of being accused of greenwashing. So is this the downside of increased scrutiny? Jonas, what do you think on that?
There's definitely been a trend, if you look on the corporate side, that you have a few quite well-known companies that realize that they really can't get out of their situation. They might produce handheld guns, for example. So what on earth are you going to do when the market is looking at you through this lens on ESG? Well, you pretty much split up the company. So you put all your camping kit and clothing in one company and you keep the handguns in the other company, and voila, you get all of a sudden bonuses and everything working on the equity side, on the camping side of the business. So there's definitely been a trend of that. There's definitely been a trend of pushing ESG obstacles in the supply or distributor chains. Now, fortunately, you can go now, 10, 15 layers underneath or in front of the companies. That is available now if you combine different systems. So you can actually start to see that some companies have been pushing sort of their, whatever you want to call it, non-compliant or brown businesses to a supplier, for example, and try to hide it away. But that starts to be pretty much rooted out. But we also should remember that, I think it was about 2 years ago that the industry got a bit of a shock that all of a sudden it was possible to open up all funds. So you could pretty much take a 6,000 company funds and open it up, and all of a sudden you had a couple of, for example, local Swedish players that had child labor in Europe. They were supposed to be sustainable. You had these awful findings, and it took about a year and a half before those funds were cleaned in that sense. So I think the greenwashing was a huge issue for the financial industry, but thanks to data, which we can criticize because it's expensive, it's also a monopolistic situation almost. It's also been really great for the sustainable cause, because finally you get rid of these kind of stupid things that you put into your so-called green funds or ESG funds or Article 9 funds, which I think, if I should put my neck out, is one of the reasons why all of a sudden, when everything became transparent and we know how numerically we should define an Article 9 fund, all of a sudden there were quite a few Article 9 funds left. And that's probably because people realized, like, oops, we can't meet these criteria. So we better do just an Article 8-ish kind of fund. So I think there's a great momentum. It's almost like, you know, this old classic saying of a snowball. It's really accelerating. It's become bigger and bigger and bigger in data. And as I said before, I mean, it's you know, we look at billions upon billions of data points in order to make this work. But that said, we also have this impression that this type of sustainability analysis will be as common as a discounted DCF, you know, equation. I mean, you base something else to do your math on and understand, like price to book sales or whatever. So there's definitely been a greenwashing, but I think it's less and less so, thanks to more and more clear definitions on what it takes on a SFDR to have an Article 9 or 8 fund.
Yeah, and thanks for highlighting that issue on the labeling of Article 8 and 9, which I think, as you say, there's coming more clarity on this. I think what I'd like to do is going back, and we have mentioned it throughout the conversation, but again, it's, you know, the difficulty of collecting qualitative, reliable ESG data. This is a challenge. We're building towards an ESAP. Well, you know, information is a challenge. We've raised it in the different points along this conversation. But I'm going to ask each of you in turn again, what are your particular views on this collecting of data and what should be done in the immediacy and perhaps in the longer term, your wish list in short. And let me go back to Ulf on this.
Well, I come back to the argument mentioned before that, you know, the collection of data is really important, and this is getting a little bit towards you know, oligopoly or almost monopolized type of market, and it is something which will benefit the large players, because if you can spread out the cost of collecting that data on a larger amount of AUM, well, you have a cost benefit in some sense, and I do think that's a little bit unfortunate. In terms of how we want the European market to develop versus some of the, you know, the other giants out there. Another thing that plays into this is also perhaps, and that is changing, but MiFID II has made it much more scarce in terms of getting research and getting, you know, more forensic analysis on that data, because, you know, that's not being provided to as broad a base as prior to MiFID II. So although MiFID II had some benefits, it's also, you know, had adverse effects in terms of how much research you can access in terms of ESG factors out there.
Yes, thank you. And that is another, of course, big topic. You know, the impact of MiFID on research, which actually CFA Institute is working with CFA Society France, and will come out soon with a study on this very topic. So Ulf, watch out for it. I'll send it to you when we get it. I'm going to turn to Anna on this as well.
Yes, and I think we are, how should I put it, data provider to the data providers. And I just, on my wish list is that I hope that CSRD will cover most of the data needed, because even if I think no one would really read our sustainability report from front to back cover, but to be one data feed into those data providers, and to be a bit less questionnaires and recommendations and ratings in the future. And the main reason, apart from minimizing my own workload, is to really secure good quality data coming from us as a company to the financial community.
Thank you very much, Anna. Yeah, and I know, Jonas, you have mentioned it, but maybe you would want to give me your wish list.
Yeah, our Christmas wish list for the next couple of years will be pretty much spot on what was just mentioned, that we get data that is sort of aligned with what we have to report from our point of view, or our regulatory point of view, from the companies themselves, like all financial reporting data. So we sort of can hopefully develop away from the situation that Ulf points out, which I think is spot on as well, that we have this weird situation that we have to pretty much buy this data. It's just too much data we're talking about in order to prove every different, all the distinctions of, for example, in Article 9, if you want to be on the safe side. So my Christmas wish list will definitely be that those two regulatory bodies or ideas or concepts, you know, becomes interlinked, so we can go and back to like we do with financial reporting data.
Before I go to you, Svante, I'm going to actually go to Patrick, because afterwards I'm going to link you into things. Patrick, do you want to comment on what are the initiatives at the EU level, and you know, your own wish list perhaps for what you think should happen?
Yeah, sure. No, I much appreciated Ulf and Jonas' comments, especially Jonas. I'm just going back to the previous conversation. I'm pleased to hear that SFDR is having a positive effect. We rarely get positive feedback, so it's good to hear that. On the data front, I think, yeah, this is a tricky one. Jonas outlined earlier how we essentially the legislation placed the burden on the financial services industry on the first hand, and indeed that created this kind of demand for the data that had to be more or less supplied by third-party data providers. He's entirely correct. And this was simply a function of the way in which the legislation was agreed and the timing of it. Obviously, we place great hope on CSRD and the ESRS underneath that to streamline operations, especially when companies are large enough to report under it. It still obviously leaves a question about the companies who aren't covered by the CSRD. Their third-party data providers will continue to play an important role. I fully accept Ulf's comment, and he's entirely right that larger financial market participants have an economy of scale advantage. It's true. Not easily solved in regulatory terms, but it is true. There is perhaps some hope on the horizon that there will be regulation also in the ESG data provider space. Here, obviously, you have to look at the Commission and not the ESAs. But ESMA has been public, and we've published a letter we sent to the Commission requesting a regulatory initiative for ESG data providers to provide some rigor around that, the way in which the methodologies are created for that data, and potentially also, you know, it's a bit to be seen, but a role for ESMA in the supervision of those entities. So perhaps Jonas might well say belatedly, but at least belatedly, there could be some also regulatory initiative to bring some rigor into this space.
No, that was, thank you for mentioning that, that indeed, that letter of ESMA, that was very important. And I think it is clear that there should be some regulation on this. Svante, I'm going to turn to you, because I'm also going to turn to you at the same time, which is linked to this data issue in a way, is the fact that, of course, EU legislators have recently reached a provisional agreement on the Directive of Corporate Sustainability Due Diligence. Now, the challenges for large and small organizations in the integration of due diligence, and again, getting all the data and getting all the information, is really quite complex. I know you have a slide to talk about this, so perhaps Roberto, Svante, if you want Roberto to share a slide where you talk about this.
Yeah, sure. No, I think coming back to the data, and I think I just comment to Jonas. I think you mentioned that you should have data for regulatory purpose. I think you should have data to develop the company and develop the business and develop the monitoring of the business. So that's I'm very afraid that we do a lot of actions here just for regulatory purposes. So this is a slide or a picture that if I look on how the Commission are working with the legislation, and this is an example for the due diligence, as you just mentioned, Justina, and unfortunately there is not any preliminary decision on this, because there's a trial going on, and there are a lot of different views from the Council and from the Parliament and from the Commission. So I think it will be debated a long time, unfortunately. So and I think this is example of how I think EU works. So I think this legislation is not evidence-based at all. And we think from Swedish point of view that is a breach of, against the EU treaty. And the sad thing also that they say, the Commission said that this will not affect the small companies, but it will do much more than the Commission thinks, because all small companies that will deliver duty services or whatever to the large companies has to agree on an agreement with the large companies that they take the risk. I think in practice it will be the small companies that will take the hit. So I think it's a very naive legislation from EU. It's total lack of understand how businesses are developed. So I think in order to sort of have a better legislation process, I think it should be much tighter communication with business, with the business society, and I think to also to have the best practice. How can we learn from the companies that are in the front? And we can see nothing of this sort of processes as far as we can see. We may be long up north, so we don't see what's happening in Brussels. But I think it's not a dialogue, and it's very complex. No evidence at all. At least legislation on the CS3D. But once again, I really think this is a very important issue. I think that companies are really working hard with trying to cope with the legislation, and there's also good business to be a good citizen in this area. So I think so it's more the medicine that I'm criticizing, not the ambition and the goals, and it's more the medicine. Thank you.
Thank you very much, Svante. We have come to the end of our webinar. We could have gone on, and I'm sorry, I apologize that I've been marching you along for the answers, but we had quite a heavy load to get through. I hope that the participants have joined, and of course there will be even more bandwidth, as I said, because we will be publishing the recording on the CFA Institute website and on the CFA Society Sweden websites, as well as sending it to all registered participants. I thank you very much, and I give the floor to Christian.
On behalf of the CFA Sweden Society and the CFA Institute, I would like to thank Johanna for a great keynote speech, and also the panelists for your great discussions, Ulf, Patrick, Jonas, Anna, and Svante. Big thank you from all of us for your thoughts. Good discussion. Have a nice evening, everyone, and thanks for joining.